Gift to NRIs and residents. Income tax, FEMA, LRS, TCS, repatriation, $1 million rule explained. Hi friends, I am C. Ushma Jain. Welcome back to my channel. Hope you are having a great day. Today, I will try to cover everything you need to know about gifts in India. I'll also explain how an NRI relative can receive gifted funds directly in their foreign bank account. There are two available routes, the LRS method and the USD 1 million repatriation scheme. And each has its own advantages and compliance considerations. So let's get straight into the details. What is meant by a gift? Under Indian law, a gift can be cash, movable property such as jewelry, share or artwork, or immovable property such as land or house. A gift in tax terms is typically something given without consideration or for an inadequate consideration. The nature of the asset and the relationship between donor and recipient determine the tax outcome. Taxability of gift in India, money. The Income Tax Act treats gift received by an individual as income in certain situations. If you receive money, immovable property or specified movable assets from a known relative and the aggregate value in financial year exceeds rupees 50,000, the entire amount is taxable in your hands under the head income from other sources. Rupees 50,000 is an aggregate threshold across the year, but few gifts are always exempt regardless of the amount, like gift from relatives as broadly defined by the Act, gift received on the occasion of marriage, gift received under will or in contemplation of death, and gifts from certain approved institutions. Keep these exemptions in mind because relationship and occasion can completely change the outcome. The following persons are regarded as relatives when it comes to gift exempt under Section 56. Spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, that is brother-in-law, sister-in-law, brother or sister of either of the parents of the individual, that is paternal or maternal uncle, aunt, any lineal ascendant or descendant of the individual like parents, grandparents, children, grandchildren, etc. Any lineal ascendant or descendant of the spouse of the individual and spouse of any of the person listed above, that is spouse of brother, sister, uncle, aunt, lineal ascendant, descendant, etc. In short, parents, children, grandparents, grandchildren, siblings, spouse, their siblings, siblings of parents and spouse of all these persons are included. People not covered are cousins, nephews, niece, friends, etc. Taxability of gift, movable and immovable property. Movable assets like shares, jewelry, art or bullion are taxed based on their fair market value, that is FMV, at the time of receipt, while immovable assets such as land or building are assessed based on the stamp duty value. Gifts received from specified relatives, as explained earlier, are fully exempt from tax, regardless of the value or type of property. However, gifts from known relatives are only exempt up to rupees 50,000 in a financial year. If the total value exceeds the threshold, the entire amount becomes taxable. Please note, ordinary personal items such as phones, furniture, TVs are generally not included in the specified list and do not attract gift taxation. Additionally, gifts received on occasions like marriage are fully exempt irrespective of the donor or value. When NRIs are involved, why FEMA RBI matters? If either donor or recipient is an NRI, the income tax rules described earlier still determine whether the gift is taxable. But you must also comply with FEMA and RBI rules which govern how funds and assets may move across borders. Let's stick to our topic and discuss how residents can transfer gift amount to an NRI relative. There are two options. First is LRS, that is Liberalized Remittance Scheme, and second is $1 million scheme. For resident donors remitting funds abroad, the LRS scheme applies. Simply put, when a resident wishes to gift funds directly to an NRI's relative foreign bank account, the LRS rules applies, and TCS may also be levied on the remittance. However, when a resident relative transfer funds to NRI's NRO account, TCS is not applicable. The NRI can remit these funds to their foreign or NRE account under $1 million scheme. The NRO bank may require the NRI to submit Form A2 along with 15 CACB certificates. Let's now discuss each option in detail. LRS gifts and tax collected at source (TCS). Under the RBI's Liberalized Remittance Scheme (LRS), a resident individual can remit up to USD 2,50,000 per financial year for permitted purposes, including gifts. It is important to ensure that your total outward remittance in a year do not exceed this limit. TCS on LRS remittances. From April 1, 2025, banks and authorized dealers collect tax collected at source (TCS) on LRS remittances exceeding rupees 10 lakh in a financial year. For purposes such as gifts, the TCS rate is 20% on the amount above rupees 10 lakh. Banks usually collect TCS at the time of remittance. TCS is not the final tax. It works like an advance tax. Resident donors can adjust the TCS against their final tax liability when filing their income tax return. If no tax is due, the TCS can be claimed as a refund through the ITR. In short, banks collect TCS upfront, but it can be recovered or adjusted during tax filing, so it doesn't become an extra tax burden. $1 million scheme, transfer of gift money to NRI's NRO account. If the resident transfers rupee funds to the NRI's NRO account in India, the immediate outward remittance under LRS has not occurred. Practically, many resident donors prefer this route because TCS is not collected at the time of the inward credit to NRO, and the NRI can subsequently repatriate funds from the NRO account under the RBI's USD 1 million repatriation facility for NRIs, subject to required documentation and tax compliance. For example, if a resident donor wishes to gift rupees 20 lakhs to an NRI abroad, under direct LRS transfer, bank may collect TCS on amount beyond the threshold, which could mean a TCS charge of a substantial sum. In our example, TCS will be 20% on the excess over rupees 10 lakh, that is rupees 2 lakh. This will be at the time of remittance. That TCS reduces the sender's immediate liquid outflow, but can be adjusted in ITR later. If we go through NRO route, resident credits rupees 20 lakh to NRI's NRO account, and from there he can repatriate it under USD 1 million scheme, subject to clearance and documentation. Bank may ask to submit gift deed, declaration, Form A2 or 15 CACB certificate. Documentation, gift deeds and compliance checklist. Regardless of the route you choose, maintain a robust paper trail. For immovable property, execute and register a gift deed and pay stamp duty as per the state law. For cash or movable assets, obtain a clear gift declaration identifying donor, recipient, relationship, value and purpose. Preserve bank remittance advices, Form 15 CACB filings, if any, and valuation certificates for high value movable or immovable gifts. Disclose taxable gifts in the recipient's ITR under income from other sources. If the gift is exempt, still maintain records and report correctly under exempt income sections where required. Transferring money across borders involve both tax and foreign exchange rules. Even when a transfer is legally permitted, banks are required to satisfy KYC and FEMA checks and may flag unusual transactions. RBI and the government periodically update LRS and repatriation guidelines. So always check the latest circulars or consult a bank or specialist before executing large cross-border gifts. To summarize briefly, gifts from relatives, gifts on marriage, and inheritance are typically exempt from gift tax. Gifts from non-relatives that aggregate to more than Rs 50,000 in a year are taxable in the recipient's hands. Gift from residents to NRI under LRS is limited to USD 2,50,000 per year and may attract TCS of 20% on excess over Rs 10 lakhs. TCS is an advanced tax adjustable in the center's ITR. Sending rupees to an NRI's NRO account and later repatriating under the USD 1 million repatriation facility is a common alternative that avoids TCS, but it requires documentation and tax compliance for repatriation. That's all for today. I hope this gives you a clear understanding of the taxability of gifts, especially when a resident sends money to an NRI. See you in my next video. Until then, take care. Bye.